morning, good afternoon, everyone. I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On today's call, just quick round robin, we've got Salih Yilmaz over in Dubai, we've got Hares and Patricio Alvarez in London, and we've got Fernando Valle in 731 Lexington in New York. I would like to just quickly advertise that on a go forward basis, we are going to start doing these calls on a weekly rotation instead of an every other week rotation. We've got a giant team, and many of the folks on the team you haven't met yet, but we've got Scott Levine in New York, we've got Vince Piazza in Wilmington, we've got Talon Custer in Princeton, who are on the North America team. We've got Hinnick Fang over in Hong Kong. There's a lot of voices that you haven't heard from, and when we look at the agenda every week, we know we want to expose you to their franchises and get them a seat at the table. So we're going to expand so that we have opportunity to really expose more of the great research being done by the team here at BI. So look forward to that and reach out to any one of us questions, or you want to make sure we cover certain topics, or even have guest speakers on, because we're always open to trying new things and hearing from lots of different voices. So that's something to look forward to, and we'll start that next week. Now, with that in mind, I will just say that I did something interesting this past week. I took a road trip in my Tesla for the first time, and I'm agnostic on what kind of car I have. I'm not really a car person, but the reason I bring that up is because as the first time I tried to do any distance in an electric vehicle, it went fine. There were no issues, and there's lots of stories out there about hijinks, and so I just think the world's changing, and there's this sense that maybe we're going to slowly sort of cycle in more electric vehicles, and this could ultimately have an enduring effect on the oil market. And the reason I wanted to start there is because if you haven't seen it yet, we've got this great new survey out. Many of you probably participated in it because it's a survey of our clients. Salih Yilmaz is really usually the analyst who kind of is responsible for running it and kind of leading the write-up. But one of the questions we asked is, when is global oil demand going to peak? We've been asking this question for a number of years now, and what I think is most interesting about the question is just how the respondents, how you seem to be changing your expectations over time, and it's this sort of this thing that people have a sense may be happening at some point in the future. Just the when of it is sort of the big thing. So Salih, kick us off with that and tell us what we heard on that particular question. I think we should definitely walk through some of the other questions and topics.
Sure. Thank you, Rob. And first of all, I should say thank you very much to everyone who has taken the survey. This is a survey that we try to do at least once a year. And as Rob said, some of those questions in there are on a recurring basis because we really like to see how the sentiment perhaps might be changing on some of the longer term questions that we ask, like peak oil demand, EV adoption, and a couple of other questions that I'll talk about in a second. But I think generally what we see in the results is perhaps a change in sentiment where the pace of energy transition seems to be faltering according to most of the respondents. Peak oil demand may actually be later than anticipated this time around. And if you look at the history of the surveys that we've done, this fluctuates quite a lot. But right now, when we compare these results to the results of last year, it seems like the peak oil demand expectations are changing, and peak oil demand may be later than anticipated. And EV adoption, quite surprisingly, at least to me, may be slowing. So if I may, I'll try to do this as briefly as possible, but I will walk through a couple of the numbers that we saw in this survey. So on the peak oil demand side, now only 22% of the respondents expect oil demand to peak before 2030. Last time, this was 50%, so that more than halved. when we look at, we had another question on this year's oil demand. So when you look at the near-term oil demand as well, 44% think that this year's oil demand will be more than 102 million barrels per day. So that would be more than 2% of year-over-year growth, which is pretty strong. Switching back to kind of the energy transition related questions, we asked about the European oil majors' energy transition capital spending, CapEx. 46% forecast this to actually never reach 50%. And our scenario analysis, I mean, our core scenario suggests that we may actually get there by 2030. So this obviously looks very conservative to us. But again, 46% thinking that will never happen. Last time we surveyed our clients, this was only 15%. So 3 times as many people, at 3 times the percentage actually expect this to never happen. On EV adoption, to your earlier point, only 12% now expect EVs to be 50% of global new car sales. This used to be 21% of the respondents, and more than half, actually 52%, don't expect this to happen until 2040. And this used to be only 40%, so from 40% to 52%. So clearly, I think all the answers to these questions are telling us that the sentiment is very much shifting to suggest that maybe energy transition might be slowing down. We had other questions. I mean, I don't want to take too long. I thought these were the most interesting bits of it, but if you haven't seen it on the terminal, we have published all the results. We will be running this over the next couple of weeks as well. But if you couldn't find it, if you'd like to talk about it, please get in touch with me or any one of us. But yeah, that's I think the bits about the energy transition, EV adoption, peak oil demand, and the EU majors transition spending were, I think, the most interesting parts this time around.
Fascinating, Salih. I'll just echo what you just said. Make sure to check out the survey. Lots of good stuff. Fernando, I got to get you to weigh in. I feel like I'm halfway triggering you every time I talk about, driving an electric vehicle, and I want to hear how you think that kind of question or thinking evolves. One of the great things about the oil business, I think these days, is you often hear people say, well, it doesn't really matter when peak oil demand is going to occur, because the industry still has to invest because of decline rates and other things. So how do you think about that question, and do you think the results have any validity?
Yeah, I mean, to me, you guys probably know I don't think it happens before 2050, and I think EV adoption, it's not unsurprisingly slowing, and will slow even further with 8% interest rates, just because fleet changes are going to slow. I mean, interest rates are going up so significantly that it'll be hard for anyone to acquire a car, be that an EV or an ICE, and just because most of the fleet is ICE, that will continue that way. And obviously, EVs are still more expensive to acquire than an ICE vehicle, and even the operational costs will probably rise because, again, we think energy costs in general are going up. I think, as you mentioned, whether it happens or not, there's a shift in how oil is consumed, and a lot of the condensate and NGLs become important even in an electrification scenario, because you need to lighten materials, so you need to produce more plastics, you need to replace steel with that, and then all the other inputs require mining, so it requires a lot more diesel, and we're just short on diesel production and even the crudes that produce more diesel. So in either case, I think there is an underinvestment in the industry today that will be reflected over the next few years. And then the last point is, as of today, we haven't really stopped using any source of energy that we developed. They've lost market share, but we still use them. Coal is still widely used, obviously, but biomass is still used. Wind obviously was used before and is used back again. It is growing. Even animal dung is still used for energy. So the one thing that it's often missed in these questions is that we haven't yet reached a marginal demand for energy. We keep consuming more energy because that is how we improve the standard of living worldwide. And when you consider that in some developed economies, the average citizen consumes less energy than an American refrigerator, the notion of peak oil is kind of silly almost. Those people need to consume more energy, and that's how we're going to improve their quality of living, and not by totally stripping out affordable sources of energy.
Well, as someone who lived without an American refrigerator for a number of years, I'm so happy to be back in the land of refrigerator abundance. Now, one of the questions that we asked this round was which segment within energy is expected to perform the best over the next 12 months. And about 80% of you, our clients, said that you think oil and gas is going to outperform wind, solar, coal, whatever segment you want to think of. And frankly, this might just be a reflection of recent trends. Solar manufacturers, solar stocks are down about 25% year to date. The wind stocks are down about 15% year to date. And the world market's up about 8%. So wind, solar, they're lagging pretty much everything else out there. And the more oil-linked MSCI energy index, it's up as well. So wind and solar, they're laggards. And at least based on the survey, you seem to suggest that they'll remain the laggards, at least for now. So Will, I want to bring you into the conversation here. Salih mentioned lots of discussion within the survey around EU oil majors and green capex or clean energy spending as a share of their overall spending. How do you see that evolving, and what do you make of the survey result?
Yeah, so the survey result was pretty surprising for me, in the scale of the expectation that these companies would never hit 50% of their capex as energy transition or green. While there is a very unambiguous trend emerging over the last 12 months where the energy transition pace for particularly the European majors is definitely slowing. But keep in mind that these came out of the gate, these strategies came out of the gate a few years back, envisaging a rapid transition. This was prior to Russia's invasion of Ukraine and the ensuing energy crisis. And what we've seen now is that some of these companies, including BP and Shell, have dialed back their expectations for how quickly they're going to enter managed decline, particularly for their hydrocarbon businesses. So, for instance, BP's adjustment for its strategy announced earlier this year sees the decline in their production from 2019 base declining 25% now to 2030 versus 40% previously. So it's a pretty material change in how they see the trajectory of their production going in the latter part of this decade. And I think an important part to note here is this isn't mostly coming as a result of lower transition spending. So most of the spending is actually remaining intact, and long-term targets for renewable power remain intact, and long-term emissions targets remain intact. It's just the higher investment within their legacy oil and gas businesses is being dialed up a bit, and this is obviously a reflection of some of the resilient demand signals that we see. Non-OPEC supplies fading in the midterm, and obviously as we see from Saudi and OPEC, a big commitment to enforcing a price floor and a relatively high oil price, which we think this market context can extend for years. So the results of the survey are surprising, but they also, in a sense, reflect what we have been seeing from some strategy adjustments from the European majors.
Okay, thank you, Will. Patricio, coming to you next. A couple of interesting questions in the survey that I think really sit within your franchise. One is, I believe this is the first time we've asked, but maybe I'm wrong about it, but I'm pretty sure this is the first time we asked when renewables power generation will exceed coal. So I want to get you to weigh in on that here if you have any thoughts. I imagine there's a little bit of regional differentiation on kind of how to think about that. And I also note that we did ask about batteries versus hydrogen versus some of the other technologies, and we did get a sense that most of our clients think batteries are going to be more meaningful in terms of their impact over the next 10 years than hydrogen or some of the other things out there, which I think is mainly something to think about in terms of the grid. So tell us your thoughts on both coal and the other sort of electric components in the survey.
Sure, I think that was the only question really about power was yeah, the renewables versus coal question, and the question was really on how long would it take the world's renewable capacity or renewable power generation to exceed that of coal, and the results were not very surprising in a way, because all of the respondents, 100% of respondents, think that this is not possible until after 2025. Which is not surprising. It seems like that would be way too early. And then you have the 100% of respondents sort of split evenly, a third each, for timelines from to 2030, 2035, and beyond 2040. So I think that shows you how how this is sort of an open question for our readers, for our clients. Because mainly I think that's because of how regionalized this process will be. While regions like Europe have policies supporting the phase out of coal-fired generation with either via auctions for like compensating utilities for closing out their capacity, and also subsidies or tax incentives to build out renewable capacity. There are other sections of the world, like Fernando was mentioning, that are still sort of in this developing stage, and will probably increase their energy per capita intensity over the next few decades, and that those are the markets that we're going to probably see still, if not a stable, even a growing a growing use of coal, at least in the midterm, until they can shift to other technologies, and perhaps that's where the case for a strengthening or demand outlook for gas is somewhere there in the middle, because gas remains sort of the lowest hanging fruit in terms of decarbonization for coal. So I think, if anything, it just shows how we're still in the this is still a very much an open question. The pace of transition is still a very much an open question when you look at a global scale.
Okay, thank you, Patricio. I know there's been so much news over the last few weeks since we last got together that we need to hit on, but I want to bring up one more question from the survey, which is we always ask what you think oil prices are going to be, and always interesting to see where you're at on that question. I think generally I got the sense that there's sort of a bullish predisposition for the survey results, and we did ask about Brent, not WTI. And one of the things that I think, if you're watching the market right now, there's been a narrowing of the spread between Brent and WTI. And so, Fernando, I want to come to you on the question of kind of what's going on with the spread between Brent and WTI, and also I'll just throw out the numbers. It's 63% of the survey participants expect Brent to be above $90 a barrel at the end of this year.
Yeah, so it's a great question. It's a lot of different things coming to a head. I think one of the biggest ones is China, and there will be no more oil import quotas, no more fuel export quotas. for 2023, and it may even slow in the first quarter. And then, so this is creating a much more difficult market on the demand side in the Asian market, increased competition, which then pushes that spread as the crude suppliers try to compete for the few consumers that are left. And then on top of that, Russia actually is restricting their fuel exports in order to hoard some fuel. But because Russia has historically been an exporting country, they don't have a ton of storage capacity, so they have limited ability to store that, which means either they won't be producing that much fuel anymore, or and they will export that crude, or they'll have to shut in crude capacity. Likely that they'll export and increase the supply, especially again into those Asian markets, bringing down the Brent price, whereas WTI continues to float to Europe. So that's one of the reasons why it's compressing. As far as the overall price, we're seeing a huge slowdown today. I think again that's been the divergence between my view and those that expect the $90 is that in the short term, I see weaker economic activity playing a really big role in the oil price, and we're seeing the Japanese yen coming under increased pressure. Questions on whether the Fed will pause or not, and all of that I think is having an effect on risk assets and Brent included, Brent and WTI included.
Well, Harris, I want to come to you just to get read across into some of the company fundamentals. One of the things that I'm always mesmerized by, especially when you look at some of the big integrateds, the long run or medium run correlation between oil price and those companies' shares is maybe not as high as you'd always think it is. So, how does the sort of fundamental backdrop on oil play into like their strategy and your outlook for the companies?
Well, of course, it remains very central for most of these companies, but I think an important point to include here is that it is becoming a decreasing share overall of not only the strategies of these companies, but how weighted they are. So we expect higher gas mix for all of these companies moving forward out to 2030. Most of them should be majority gas producers within the next handful of years, if they aren't already. And this is a big focus on developing their LNG portfolios, mostly with the exception of Equinor. So gas is continued to be seen as the transition fuel for what is increasingly now seen as a longer extended transition. So oil price, of course, still incredibly important, and the primary cash generator for these companies, but it is gradually decreasing. So the average oil as a percentage of the production mix is somewhere around 45% right now. Gas is around 45%, and oil is 55%. But we expect that's declined to majority gas by the end of the decade.
In your sense, is there a certain oil price that's necessary to maintain the capital return programs that many of these companies have in place?
This hasn't really been a topic of late. I mean, during COVID, it was incredibly important finding out where their break-even price was. I think that this has loosened quite a bit within their capital frameworks, but somewhere around $60 a barrel is probably in the range for where most of these companies are budgeting. But yeah, they're keep in mind that they are spending about roughly 20% of their capex now on non-oil and gas projects. So renewable power, mostly some EV charging infrastructure, hydrogen, and other areas as well. So I'd say that somewhere around $60 a barrel, but this is not really that topical for the way that management is looking right now, because oil prices are so strong.
Salih, let's bring you into the conversation here. Obviously, capital returns are important for Saudi Aramco and some of the other companies in your space, and like to get your sense on kind of where they are certainly wanting oil prices to be to maintain that for them. And I would also be curious to hear your contrast a little bit from Fernando. Fernando sort of played up some of the economic factors that may be creeping into the narrative around the oil market. Obviously, OPEC is trying to counterbalance that. We've got the survey results. Kind of where does OPEC and some of the geopolitics fit into the oil market equation when you look out over the next 3, 6, 12 months?
Sure. Thank you, Rob. I think these are related, so I'll try to kind of answer both questions in one go. I mean, for Saudi Aramco, the profitability has been so good the last couple of years, and they're not really trying to keep that capital discipline perhaps as much as some of the European majors. They've been planning to increase their capex for the last couple of years significantly. And at the same time, I mean, perhaps they don't have the same type of shareholder pressure to be increasing their returns, and they don't do buybacks. But what we've been seeing recently is that they've been trying to increase their dividend. And part of this is, they want their dividend yield to be higher and closer to some of the global peers. But at the same time, a big portion, we should remember, a big portion of that dividend is actually going to the Saudi government. And just earlier today, actually, I was talking to our economist who covers Saudi Arabia about the fiscal break-even price for Saudi Arabia. And I think the number, the IMF numbers that everybody is familiar with for 2023 suggests that Saudi Arabia's fiscal break-even price might be around $80 a barrel. But obviously, this was an estimate that was done earlier in the year. The total amount of spending by the kingdom can change this calculation. Obviously, that dividend that's coming from Aramco in the second half of the year changes this calculation. But that scenario analysis we were doing suggests that perhaps that fiscal break-even price might be higher than what the IMF is suggesting. So with all that in mind, kind of perhaps contrasting Fernando's view, it is clear to me that Saudi Arabia, which is the de facto leader of OPEC and OPEC Plus, is going to continue to try to protect the price floor, which perhaps, we were arguing maybe that floor is around $80 a barrel, but that floor is probably higher for Saudi Arabia. It's probably around $90 a barrel. So we had both Brent and WTI below $90 a barrel today. If it continues to go down, it wouldn't be a huge surprise to me if we see even deeper cuts by Saudi Arabia at some point before the end of the year. So clearly there's a lot of macro pressure. And of course, there's the self-defeating parts of this whole kind of OPEC plus cuts where they cut, oil prices go higher, Fed says they're going to hike more because of the inflation worries, and more hikes, market gets a lot more anxious about the oil demand implications, and then oil price goes down again. So all in all, there is, of course, that macro anxiety, I understand, but I think on the supply side, I have no doubt that the group will continue to be very defensive and very aggressive in trying to protect that price. So I think the $90 to $100 a barrel by the end of the year, which was what the majority thought in the BI survey, I tend to agree with that view for the last quarter of the year and towards the end of the year.
Thank you, Salih. Patricio, I want to come over to you and sort of noodle on the same theme. Your companies, capital returns, capex, all of these things, you're dealing with some of the same kind of issues. Higher interest rates are deeply intertwined with kind of how people typically think about utilities. So what's going on in your space? Are the companies going to continue, their strategies with dividend payments and everything like that? And are interest rates affecting their ability to make the kind of capital allocations they're trying to do?
Yeah, absolutely. So this sort of period of higher for longer interest rates and inflation will have divergent effects on the European utility sector, mainly depending or differentiating those who from those who have regulated assets like infrastructure, power networks, or gas networks versus those who are more focused on renewable development. Why do I say that? It's because higher interest rates and financing costs are becoming a heavy headwind on renewable development, and that's mainly for offshore wind, especially just because of the upfront capital requirements that you have in that space. And given that many developers signed fixed price power purchase agreements a few years ago, those do not reflect the run up in cost that we've seen over the past 2 or 3 years as interest rates rose. So those developers, or let's say that peer group, is more exposed to return pressures already on assets that are lower return relative to, let's say, traditional flagship oil and gas investments or infrastructure investments. Let's say like a rule of thumb would be like when debt was cheaper, industry leaders like Ørsted could achieve something around 14% on their capital employed, and that's using significant amount of leverage and considering the company's the offshore leader, let's say. So that return profile is significantly crimped amid the current landscape, and so we see sort of less potential for dividend upside, although we don't see any cracks in their current financial frameworks, meaning that we don't expect any dividend cuts, at least not in the near term. That sector is more exposed to this shift in the cost of capital. And on the other end of the spectrum within utilities, you have the more defensive names, so companies that most of their earnings come from operating regulated assets. Those companies are sort of more of your traditional utility like investments, really, which do have a set amount of regulated returns that are almost guaranteed by the regulator, and most of them do reflect or cover increases in debt costs and also cover increases in inflation for cost, or at least in part. So those investments are very much in a good position to weather this environment, and perhaps the potential slowing of energy demand, which is another concern. So trying to sum that up, I'd say it's like that the higher interest rate environment will definitely impact European utilities investment momentum, and that will definitely also impact their capacity for dividend payouts, particularly given that European utilities are the second most levered subsector within the broader market, only behind infrastructure. So with that in mind, I think there won't be much upside for payouts, at least not in the current environment.
Thank you, Patricio. We're going to take a few more minutes of your time. We always have so much on that we could discuss on these calls, and we don't get to everything. But a couple of important pieces of news that have happened since we've last talked to you that I think we should just mention here. So, Will Hares, I want to come to you. We've obviously had a change in leadership at BP. Everybody can go read the story about what happened, but what do you make of the change in terms of how to think about the company's strategy and what's next for BP?
Yeah, so I think it's important to frame Bernard Looney, the ex-CEO's role in BP's strategy, to understand how we think it's going to evolve with him now departed. He implemented an extremely rapid and risky energy transition, in our view, the fastest of any of its peers by far. It planned out a material drop in hydrocarbon production, a massive ramp in renewable power, in low return renewable power. We also saw some extremely aggressive bidding in offshore wind leases. So much so that some of these projects would effectively be near unprofitable. So there was a lot of risk involved with the pace of the energy transition that Mr. Looney saw and was directing in BP's strategy. and we think that's sort of been and since that's been dialed back, as I mentioned earlier, I think the market responded very positively to that. In a slower energy transition phase, more returns focused, and so we think that this won't be lost on his successor for CEO. The current interim CEO is Murray Auchincloss, who's who was the CFO. So he's running things for the time being, and whether they select internally, which I think is probably more likely than externally, I think there's a chance here for a more returns focus in the strategy. Not saying back to an Exxon or Chevron sort of strategy, full oil growth, but maybe slightly more focused on easing that transition pace. And I think just finally, it's worth noting that BP's performance from the beginning of Mr. Looney's tenure has been by far the worst of all of their Western global oil major peers. So they total return of 40% versus the group return of 80%. They are either at the bottom or have lagged near the bottom on valuation on a forward PE metric as well. So there was the question, was initially before the details of why his departure occurred happened, was this performance related? And the BP board was very clear that it wasn't. Although I think just the nature of that question being asked suggests that there's enough apprehension and uneasiness within some of the BP's investors about the performance that the company has shown in the last few years.
Very interesting, Will. Okay, Salih, I want to come to you. You're going to get the last word. I know you spent a few days at the ADIPEC conference in Abu Dhabi. What kind of themes are you hearing? Anything major takeaways coming out of the event that you want to share with the group here?
Sure. I mean, I'll try to be very brief. But to be honest, going back to the first point that we were talking about from the survey, I thought there is much more optimism at the ADIPEC conference this year. I mean, of course, decarbonization, climate are still big discussion points, but from what we were hearing from the industry leaders are that they seem a lot more confident about committing to the legacy oil and gas businesses. I mean, we had a lot of the European oil major CEOs in panels, and they're committing to increasing spending into energy transition as well. But they seemed a lot more comfortable and optimistic about the future of the oil and gas of their oil and gas businesses as well. And perhaps, I mean, the energy crisis of last year and just the legacy oil and gas business segments doing so much better, the benchmark oil prices, oil and gas prices still remaining very elevated, are driving this type of sentiment. But yeah, I mean, it was perhaps compared to a few years ago, they were very open and very confident about energy security. We've all seen and kind of reminded that it is a priority, and that's why we, they said that they need to be reinvesting into oil and gas as well. And one interesting point, obviously ADIPEC takes place in Abu Dhabi, and this is just about 2 months before the COP28, which will take place in Dubai, just an hour away from Abu Dhabi in the United Arab Emirates. And a lot of what they were talking about was how it is a good thing that there will be a seat for the oil and gas industry. As we've discussed on this call multiple times before, what has been quite controversial was the president of COP28 is actually going to be the CEO of ADNOC, the national oil company of the UAE, which again was very controversial. But what comes with that is obviously at this climate conference there will be a lot of oil and gas leaders and C-suite as well. So That was generally the vibe that I got from the first couple of days at ADIPEC. A lot of optimism about oil and gas, a lot more confidence about reinvesting in the sector.
Okay, thank you so much, Salih. We're going to make that the last word. For everyone listening, please go check out the survey. You can find it in many ways. Run bio for Salih's name. He's lead author on it. You can go check out, read through the results. A lot of interesting stuff in there related to much of the conversation we've had here on the call today. And I implore you, next week, we're going to start moving to a weekly cadence for these calls. We've got Vince Piazza, Scott Levine, Talon Custer, and then Salih Yilmaz, who are going to join next week. And so we look forward to having conversation with our colleagues, who many of them you might already know from various engagements over the years. Make sure to join that same kind of fun discussion. What's going on? What have we worked on? What's happening in the markets? Come here to get that. And we look forward to being in touch. As always, shoot us an email or an IB if you have any questions, and we look forward to hearing from you. Take care.